Okay, so let's unpack this deep dive. We've looked at a whole range of sources today. We're seeing things on global energy, on raw material supply, and local infrastructure constraints. And what's interesting is how these three separate zones all seem to be feeling the same kind of pressure. So for you listening, if you just want that shortcut to being well-informed, what's the simplest, clearest way to summarize the overall vector of the world right now?
The immediate takeaway is that the global system is structurally moving towards constraint and friction.
Constraint and friction.
Yeah, and it's a nuanced point. The challenge isn't really the availability of the resources themselves. I mean,
Hmm.
we're not about to run out of oil or key minerals tomorrow. The real constraint is the institutional and logistical pathways those resources have to travel.
The pathways.
Exactly. Think of it like this. The global economy is being taxed, but not by scarcity. It's being taxed by complexity. You've got sanctions, insurance costs, national quotas, local zoning rules, just aging infrastructure. Those are now the things driving cost and instability. The path to market matters so much more than the actual item being moved.
That's a really foundational insight for understanding how things work today. It perfectly frames the mission for this deep dive. So let's jump into the three biggest topics we found that are, well, actively creating this friction, starting with the heart of global energy, the oil market.
Right, so we need to set the stage for the oil markets. Globally, there's this foundational supply cushion. Basically, more oil is available than is needed for immediate use. And that's why 2025 saw one of the biggest annual drops in crude oil prices since, the post-pandemic recovery. It's just been loose supply and demand.
Okay, so that's the background. And what happened now is that OPEC plus the big coalition of oil producers is expected to maintain its current production halt. And not just for a month, but through the whole first quarter. And what's surprising here, I think, is that this is happening even with all this political tension inside the group.
That's the key. Exactly. We're seeing all these reports of friction, right?
Yeah.
Specifically, that public spat between Saudi Arabia and the UAE over regional policies. Normally, that kind of tension would create uncertainty. You
Yeah.
expect someone to break ranks, try to grab market share, and prices would just swing wildly.
But they didn't.
No, they stuck to the plan. And that decision to hold the line on output cuts, it tells us that the dominant psychology right now within OPEC Plus is all about stability. They're basically betting that the bigger risk isn't some sudden geopolitical shock that makes prices spike. The real risk for them is long-term oversupply keeping prices way too low.
So they're choosing cautious stability over, potential short-term gains. But how does a decision like that, made in Riyadh or Abu Dhabi, actually affect us in our daily lives?
Well, it has a really strong real-life impact on predictability. That's stability. It underpins everything. Fuel, electricity, transportation costs, all in the short to mid-term. If the big producers can manage a price floor and stop a collapse, it keeps their own budget stable, sure. But for global logistics, it gives a degree of predictability to fuel cost for ships, for trucks. And that kind of dampens consumer price volatility everywhere.
It makes planning just a little less frantic.
A little less frantic across the entire supply chain, yes.
Okay, so that's stability through constraint. Now let's pivot to a zone of deliberate manufactured constraint. Venezuela. The U.S. has this long-term strategy of using financial and trade restrictions against the Maduro government. But at the same time, you've got Maduro sending these signals about opening up serious discussions. It's a weird mix.
And this latest move just confirms that pressure strategy. The U.S. has imposed additional sanctions on Venezuela's oil sector. But the key distinction this time, and this is really important, is that the pressure is specifically on the maritime operations, on the tankers themselves.
And this is where that passageway matters more than the resource idea really comes to life, isn't it?
It's the perfect example.
Venezuela still has the oil. The physical volume is there. This new action, it isn't really a restriction on supply volume. It's a direct constraint on the pathway of that supply.
Precisely. By going after the vessels and the companies that own them, the friction just increases exponentially.
Right.
I mean, who is going to insure that tanker now? Which banks are going to process the payments? Even for the shadow fleet of older ships, it just gets more expensive, more complicated to find anyone willing to take that heightened political risk.
So even if the price of crude oil itself is stable, the cost to move it safely, legally, with insurance, could jump by, say, 20%.
It's a huge logistical tax.
Yeah, a tax applied entirely by institutional friction.
That's it. It just makes the whole transaction more complicated no matter what the oil itself is worth.
Yeah.
It really shows how a political decision can just jack up the operational cost for everyone down the line.
Okay, let's move to another source of this friction, one driven by active conflict. the war in Ukraine. We keep seeing this reliance on what some call infrastructure warfare strikes on key sites far from the front lines.
That's right. It's an evolving tactic. It's designed to hit the war effort economically, not just on the battlefield. So yesterday, Ukrainian drones hit energy targets across multiple regions in Russia. And the key detail there is the geographical spread. The contested zone is just getting wider and wider.
And when these places get hit, the first question everyone asks is, how much oil processing capacity was lost? But our sources are pointing to something less tangible driving the real impact. What's the story there?
Well, what's fascinating here, and it's a lot like the Venezuela sanctions, is that the primary long-term effect isn't the amount of oil lost in some fire. It's the huge surge in the risk premium.
The risk premium.
The risk premium associated with handling that energy from that point forward. If you're an insurance company underwriting a refinery or a shipping company in the Black Sea, your cost to protect yourself just jump immediately. And as the conflict spreads out geographically, corporate contingency planning, how companies manage risk, it just hardens. They build in these massive buffers for delays and for risk.
So that caution, that extra planning, it gets translated directly into higher prices for the consumer again.
Absolutely. Logistics delays, higher costs. They spread so much more easily when a company decides, okay, this entire region is now a higher risk zone. They get more cautious about sending ships, about storing resources there, and that higher cost of doing business eventually gets passed on to the end consumer, whether they're buying Russian oil or just some product that had to move through a nearby shipping lane.
Right. So we've seen how institutional and geopolitical friction is really taxing that global energy passageway. But friction isn't just from strikes or sanctions. It also comes from domestic policy. So let's look at resource governance, moving from oil to critical minerals. We see the same theme.
Yeah, this starts in Southeast Asia, our first one. Indonesia. It's a massive supplier of nickel, which, is vital for EV batteries and stainless steel. And Indonesia just announced it would be reducing its mining production quotas.
Okay, on the surface, that just sounds like internal policy news. Why should a global manufacturer or just an average person care about Indonesia's nickel quota?
Well, because it's an incredibly powerful supply-side lever. Indonesia's pulling that lever to manage and, frankly, to boost global prices. They have market dominance. So when a massive producer like that manipulates quotas, they're really exerting geopolitical influence through economic policy. It directly hits the input prices for everything, from your next car to your kitchen appliances. Manufacturers are forced to adjust their long-term plans basically overnight.
Okay, so that's an aggressive policy lever. Let's contrast that with our next point from the Democratic Republic of Congo, which dominates the world's cobalt supply. The DRC delayed the start of its 2025 cobalt quota system and extended the current shipment deadlines.
This is a perfect counterpoint. Here, the bottleneck isn't deliberate price manipulation. It's not conflict. It's just sheer regulatory and institutional complexity.
Bureaucracy.
Pure bureaucracy, procedural delays, capacity issues in the government. And because the DRC is so critical for cobalt, this kind of administrative delay translates directly into more risk and more cost for anyone trying to procure materials for EVs. Automakers, battery makers, they need certainty. They plan years out. A bureaucratic delay in a system that controls most of the world's cobalt.
Yeah.
It's just a huge, expensive planning nightmare.
So we have friction from deliberate quotas and friction from just slow-moving bureaucracy, two sides of the same institutional coin. Okay, now let's shift to friction caused not by policy, but by just pure, relentless global demand, specifically from data centers and AI. We're moving to the urban level now.
Right, and we're seeing this big shift in how cities are reacting. Take Bay City, Michigan. They started drafting zoning and development standards before any major data center proposals even landed on their desk.
So Bay City is acting like a bouncer at the Energy Club. They're setting the dress code before anyone even knocks on the door.
That's a great way to put it. It's a really clear, city-driven shift. Cities are realizing the massive power demands, the environmental impact, especially on water, that these facilities have.
They're getting ahead of it.
They're moving from just attracting development at any cost to imposing specific acceptance conditions right up front. They're setting the rules for their local passageway to protect their own infrastructure.
And that local friction leads us straight to California, where the power demand is just exploding. Instead of imposing heavy regulations right away, the state mandated a study to figure out who should actually pay for the system upgrades needed to handle this AI and data center boom.
And this raises the fundamental question for the future of our cities. Who assumes the risk of this surging, unpredictable demand? We know the grid needs massive reinforcement, but that costs billions of dollars. This debate over cost allocation, should it be the utilities, the wealthy DC developers causing the surge? Or should it just be spread among all of us, taxpayers and residents, through higher bills? That debate is now central to how utility rates will be set in the future.
And finally, that brings us to South Boston, Virginia, which is trying to fight the physical bottleneck head-on. They invested in manufacturing capacity for large system components, specifically large transformers, just to boost their local power receiving capability.
That is a highly tactical move.
Yep.
People don't realize this, but transmission and transformer supply have quietly become one of the most critical physical bottlenecks in the world.
Right, these things take forever to build.
Forever to build and install. And the existing manufacturing capacity is often booked solid for years. So if a city wants to attract a new factory, they can't wait 5 years for a transformer to roll off an assembly line somewhere in Asia.
So they're building their own.
Exactly. This shows cities and regions actively investing just to play catch-up with this relentless demand. They're not just tweaking policies or studying costs, they're physically fixing the supply capacity of the power grid itself. They recognize that the physical parts of the passageway are often the weakest links.
So this deep dive began with this idea of structural friction. We've mapped it in oil logistics on the seas and mineral quotas at the state level, and now with this intense power grid friction in our cities. When you put those three layers together, what's the overall picture that emerges?
Well, if you connect it all back to that bigger picture, the major structural change happening is that supply chains are now primarily governed by the design of the passageways. It's not about the hole in the ground where the resource comes from anymore. It's the sanctions, the insurance rules, the national quotas, the utility regulations. Those are the active levers.
So bureaucratic friction can be just as impactful as a geopolitical conflict.
Just as potent and just as destabilizing. The world isn't really running out of things. It's running out of smooth, reliable, and affordable ways to move and process them.
That is a powerful and really memorable takeaway. So if we accept this growing friction and this focus on infrastructure as the main theme, what should we all be paying attention to next? Where's the tension headed?
I think the highest midterm significance is absolutely in that convergence of electricity and data centers. Grid reinforcement, new pricing models, cooling water usage that is going to dominate municipal and state politics for the next couple of years.
Okay.
However, the one tension point that will inevitably follow, and it's a critical lagging indicator, is our physical ability to actually do all this stuff. We have all these great plans for new transformers and grid upgrades, but who has the skilled workers? We are facing a crucial shortage of skilled labor in utility maintenance and electrical engineering, in heavy construction.
The human cap.
The human talent shortage. That's the next critical pressure point. We can design the perfect passageway, but if we can't find the qualified hands to build it and maintain it, all that institutional friction is just going to lead to physical failure. That labor shortage, that's the next bottleneck to watch.